Hey, everybody, and welcome back to another episode of the Indy Investor Pod. I have Grant Anderson joining me today. I'm excited. Grant and I have been talking for a couple months now of like, hey, we need to get you on here. I can't believe I've done, this many episodes and I had Grant on here yet because he's just a wealth of knowledge when it comes to real estate and Indy stuff as well. So, Grant, thanks a lot for joining me. I'm excited to have you on here. How you doing, man?
Great. Thanks for having me here. I know you guys provide a lot of education to people out there by listening to your podcast and Facebook and everything you guys do. So I'm happy to be here. I'm happy to help everybody out. So hopefully people learn something today.
Yeah, definitely. So if you ever had a conversation with Grant, you're going to learn something. So I know that that's good stuff. So Grant, we're gonna break this into two different episodes. So we're gonna do kind of a back-to-back episodes here. We're gonna do two different things. We're gonna focus on 1031 exchanges and the BRRRR strategy, and kind of break those into two episodes and things. But before we get into that, I would love for you to just kind of share with everybody a little bit of your story. So you're active in Cyria. You've led subgroups. You're an out-of-state investor that moved into Indy as well, and kind of so just give everybody a little bit of kind of your background and how you ended up in Indy and how you got into real estate, man.
Yeah, definitely. I started in real estate back in college. I grew up in first I grew up in Northern California. Never really moved out of state or anything like that. Went to Sacramento State University. While I was in college, I read the book that a lot of people start their real estate career off with Rich Dad, Poor Dad. After I read that, I said, I really want to buy a house. It was around 2001. Luckily, my dad had trusted me and said, okay, I'll co-sign with you to get the loan. I got the loan while I was still in college. The second I graduated, got a full-time job, I refinanced, took my dad off the loan. I didn't want him to be on there. But I did house hacking before that was a cool thing. So I rented out the 2 rooms to my roommates. And shortly after that, I got married to my wife, Rebecca, who I know a lot of you probably already realize she's a real estate agent here in Indianapolis as well. But I wanted to buy more rental property. So I around 2008, our prices were going up in California, and so I couldn't buy out there. So I decided to buy out of state in Oklahoma, actually, not even in Indianapolis. And then the market crashed in California. We bought a couple more rental properties out there, took on some partners. I was also doing some flips and some wholesaling. But I really found the strategy of wanting to buy more rental properties. So that's what I kind of focus on my attention. And around 2017, I started realizing that you couldn't buy houses out in California and still cash flow. And I was thinking that the market was going to start being in a bubble and start dropping, and there's no way prices are going to keep growing. Oh, I was wrong about that, but that's all right. So we decided to sell everything out in California. That took us a couple of years, but my wife and I decided, let's move to Indianapolis. We had already started doing a little bit of investing out here, and we decided to move. We could have moved anywhere. And part of the reasons why we decided Indianapolis was, one, the landlord-tenant laws. Yeah. So it's more favorable towards the landlord. And I always say you have to run your business as a business, and you want to treat people fairly. So I treat all of our residents fairly, but I want to make sure that if they're not going to treat me fairly, I can get them out quickly. Because it's a business, I need to make money. Yep. So that was the first scenario. The second one, I wanted a really close place to fly back and forth from California, because we didn't plan on moving in the beginning. And Indianapolis is a little bit further than that. But I really liked the city. I liked the fact that the colleges were close by. A lot of younger people were moving here. I just started seeing there is some growth potential in Indianapolis. And being in the Midwest, there was a couple of things. I wasn't necessarily looking for appreciation. Now, over those years, obviously appreciation has happened. but I was more focused on, okay, we're going to hold on to these properties that we're going to buy out here for 10 years. We're going to do debt pay down and have the tenant pay. So we're not expecting a lot of appreciation. We're more expecting to hold on to them for a long time. Debt is going to be paid down by the tenant, and we're going to make a little bit of money during that time frame. So that's why we chose Indianapolis. And I came out here before we even bought a house. I flew out here and visited, met with a couple of wholesalers, met with contractors, met some people, had some bad experiences with some contractors, as a lot of people do, especially from being out of state. And that was one of the other catalysts that said, hey, let's just move out there. We're going to meet people. We're going to learn the market. We're going to figure everything out if we're out there. When I first came out here, I didn't know what SIREA and INREA and all the different REAs. So I started looking around, and I found the niche with SIREA just because it seemed to fit me a little bit more. But what I learned out in California was volunteering. So volunteering my time to help out, to one is going to help me to learn the people that are actually doing deals in Indianapolis, and to learn the market and to figure out the people who are really deal makers. Because out in California, I did the same thing. I went to a REIA. I started volunteering. I met the guy who ran it. He is one of my mentors, and I still look at him as a mentor. But those are the types of things that you meet when you help volunteer and you're willing to put yourself out there. I know you kind of did some of the same things, willing to go do a lot of things, but you can learn a lot of people, who's actually doing deals, who the good people are, who you can find a good mentor. And it doesn't necessarily cost you anything, but maybe time and energy. And we all have abilities to go do that. And even if you're thinking, I was an ex-accountant, so I had that ability to go in and help somebody with their books. But everybody has some type of a little thing that they can do to help volunteer, to help out with something. Yeah. Everybody has some type of experience, something they can do.
Yeah. Even if it's just being a body and giving up time and stuff, whatever it is and stuff. So no, that's really, I think that's originally how you and I first connected like 3 years ago, is because we were at a lunch that, Vicky Perry was like, we were volunteering for something. Like, hey, we just want to help out. We want to do whatever. And, we learned real quick of like, Vicky will find something for you.
Yeah. So. Vicky will find something for you. Definitely.
So. No, that's awesome. I love your journey. I love to hear that story of even like, when you graduated and you're house hacking and stuff like that. You have the sense to kind of jump on that before, house hacking before it was cool and things, because you realize like, hey, there's some potential here and stuff. And then looking into the potential too that Indianapolis has. And you've been out here for what, about over 3 years now?
Four and a half or three.
Okay.
4.5 years.
Yeah. 4.5. And it's something that you kind of mentioned too. And one of the things I really appreciate about Indianapolis is actually the appreciation, because Indianapolis is not known as a city you're going to get a ton of appreciation for. It's known as being steady. It's known as being stable. And that's what we've seen. But I'm sure you've seen, and that's one of the reasons that you invested in here, but from the 4 years you've been out here, you've actually seen the appreciation come here as well and things, because like you said, there's people moving here. There's, there's kind of the younger generations are coming in. There's a lot of investors that are coming in as well. So there also has been that appreciation that Indianapolis hasn't been known for in the past and things, which is really cool.
And, I would always caution everybody, just, have that strategy to be a long-term, especially rental properties.
Yeah.
Long-term, you have debt pay down. So with debt pay down, you can weather a lot of storms. Yep. You don't have to bank on appreciation. If you're banking on only appreciation, which a lot of people did in 2007 and 8, I believe they're basically gambling. They're not investing. They're gambling.
Right. Yeah. Especially when you're looking at like property values now, like when you're counting on like, is it always going to stay here? Let's say we were just having that conversation before we even jumped on. Like, what's the reason that prices are where they are? It's a little bit of everything going on. So you can't always count on that it's going to be like this and things. Yeah. But, so Grant, one of the, I remember about 3 years ago, you had just finished, you called me up and said, hey, I just finished, I'm doing a 1031 exchange. We just sold our property in California. I'm looking for one. At that time I had a property for you out in Avon, and we did that deal together and stuff like that. But that was really the first time I was a part of someone doing like a 1031 exchange. I was still kind of new into the real estate space at that time and things. So, but I think it's something that I would like to dig in with you today on, and just kind of talk about for our listeners out there too, of just, hey, what you were able to do with 1031 exchanges, how they could utilize it as well. And then just, of course, getting into some things like, hey, be careful of this, look out for this, that type of stuff. So let's just kind of get into the nuts and bolts of what is a 1031 exchange. And of course, we'll have to follow up too, because that's like kind of the hot topic now with like, oh, what's Biden going to do with 1031 exchanges?
Yeah.
Are they going to be gone? That type of stuff. So we'll get into that as well. But let's start off with just like, what is a 1031 exchange, and how could a real estate investor utilize that to their benefit?
Well, first, let me disclaim I'm not an attorney, and I'm not
Good job.
An accommodator for 1031 exchanges. It's based on basically what I know and my knowledge and everything about a 1031 exchange. But the basic principle is that it's a tax deferral. I mean, you don't pay the tax when you sell a house today or a property today. You'll pay it later on when you sell the subsequent or third or fourth. Now, once you get to that point, there are ways to get around paying those taxes still. Consult your CPA when you get to that. That's a lot more tax strategies, but the basic thing is it's tax deferral. So you basically just take all the tax gain that you have and you transfer it to a new property. There's some rules that you have to follow. The basic rules are you have 45 days to find and locate properties. Now, you don't have to buy all of those properties that you find and you locate. And then you have a total of 180 days to actually close on those properties. There's different rules that you have to follow with the type of properties that you can look for. Particularly what we were doing is we were selling one property out in California and buying 3 properties out here. You have to spend all of the money that you receive. So let's say you sell a house for $200,000, you have to buy properties that at least equal $200,000 or more. You have to use all the cash that you've received, and you have to replace the loan. Now, you don't have to go get a new loan. If you have the cash in your pocket, you can put that in. The other big thing that a lot of people don't realize is the entities have to be the same. So if you own the property that you're selling in your personal name, you have to buy the new ones in your personal name, and vice versa. If it's an LLC, they have to be the same LLC. It has to be vested the same. So that's a big thing that a lot of people don't realize if they don't have that set up already. We didn't have our properties in LLCs, so we created an LLC, put them into the LLC right away, then sold them. So you don't have to like hold on to it for a long time in that LLC. But you do have to traditionally hold on to the property for at least a year to gain capital gains. So a lot of people will ask, can you do a 1031 exchange on a flip? And I always have trouble answering that, because when I talk to my CPA, it's all about your intent. Right. So what was your initial intent? If your initial intent was to buy it, rehab it, and sell it, no, it's not. Even if you held on to it for 5 years doing that rehab.
Right.
Because that's a active income, because that was what your intent was. Now, if your intent was to purchase the property and hold on to it for a long time, but you happen to fix it up, and man, the market is really good, and I've got this other opportunity over here, I can sell this property and buy this one. Well, you might be able to slide that into your 1031 exchange, because that was not your intent to flip it. Well, obviously, I would say talk to your CPA, make sure. But that's what my CPA has told me, and that's what I've always gone with. But typically, we've always held on to ours more than 1 or 2 years before we sold them, so we didn't have that issue at all.
Right. So, and then you're using your strategy to find more rental properties. Basically, you're holding them long term. That's what you're doing with it, and that's the strategy you've decided to take with that. Yep.
And the reason why we were doing that is, one, these are what I would look at when I'm doing a 1031 exchange. I always look at what my return on my equity is. So a lot of people talk about their return on the cash that they put in. Well, if you have, I mean, we had in most of our properties like $80,000 to $100,000 worth of equity. So if I'm looking at a $200,000 property with $100,000 worth of equity and it goes up 2%, well, my equity that's sitting there is cash that I can tap into in some way, like getting a line of credit, refinancing, doing a 1031 exchange. So I looked at that and I said, look, if I have one property and I can transfer that into 3 properties, well, now I have 3 properties probably worth more than 200,000, and I have less money in each one, less risk, because if I have 3 properties compared to 1, if I have a vacancy, I have 2 other properties to help cover that. So some of my risk is gone down because I have more properties. But you could do the same thing if you have 5 single family, you want to buy an apartment complex. You can sell the 5 and transfer it into 1 property. So you can go either way, 1 to more or more to 1.
Yeah.
Kind of.
more, less properties, but more doors maybe. So
yeah.
So awesome. What, you brought up the point of like, making sure that it has equal value and stuff like that. I know that's a kind of a common question that I get, and I'll kind of throw it over to you, is like, what happens if like you come up like a little, like $10,000 short or $10,000 over? Like what happens in those situations?
Well, if you go over, nothing.
Yeah.
If you go under, you're just going to pay tax on the difference.
Yeah.
So, which is a much better thing, that you're going to have to pay tax on the smaller amount than the larger amount.
Right.
So even if you can't find a property. So what we were doing is, because of the strict time frames, and we were buying 3, it was always difficult to try and locate 3 properties. So sometimes we would use the 200% rule. So there's 3 different rules that you can do. You can do either just 3 properties on your locating property. So you can just do 3 properties, and if you do 3 properties, only 3 properties that you can identify, and you have to buy 1 of those.
Okay.
You can do the 200% rule, which means you can do 200% of the value. So if I sold a house for 200,000, I can locate properties worth 400,000, and I can do 1 property, 10 properties. It doesn't matter how many properties I locate. And that's the strategy we were doing. So we were usually within the first couple of weeks, we would get 1 or 2, because we knew it was happening, right? Because 30-day close on the other side, we were already looking for properties, trying to get the ones. So we would try and identify at least 1 or 2, but sometimes that third one may hang out there longer trying to find one. So we might write down a couple that look like they're decent deals, but maybe we'd be interested. They're on the market. We think they're overpriced or something. We'll just identify it, hoping that if we can't, we have a backup basically. Yeah. So we have a couple of backups, and it's worked out perfectly fine that we've always gotten our first properties. Now, we could also buy a little bit higher price. We can pay a little bit more, because I look at it kind of like a free money, right? I'm taking equity out of 1 property. So I didn't have, but I don't want to still buy a bad deal. Like I don't want to buy negative cash flow. I don't want to buy anything that's not going to be a good deal for the numbers. I would just pass on it, and then I might end up paying tax on it. And that's fine, because at least I got some other properties, saved some taxes, shifted it back and forth. So I would never buy a bad property in a 1031 just to save your taxes, because your headache will be like much worse later on.
It's okay to pay a little bit of capital gains if you need to, versus having a bad asset on your hands or something.
Exactly.
Yeah. So, Grant, on the front end, like what do people need to have to like just be prepared, or what information do they need to be able to hand over, just to be ready to do a 1031 exchange, just to get in that mindset, but then also just to be ready to go with your accountant, with your properties, and with all that stuff.
So the first thing you need to do is contact an exchange accommodator before you close on that property. I know I've always used asset preservation. Based out in California, but they'll be able to do anywhere, any state. I've heard Jeff Jinks does. He reached out to me. He told me that he does 1031 exchange accommodating. But you just need to make sure that you have an accommodator and you know who that accommodator is, and you can vet them, because what happens is the money goes directly to them. You don't ever touch the money. So this is why you have to set it up before you actually sell the property. You have to set that up to where they get the money and then they distribute it based on what you say. So, if somebody is saying, "Oh, I'm an exchange accommodator," but they don't have all the, they're taking your money, right? So
Yeah.
you want to make sure that they're a proper business, and they could be taking hundreds of thousands of dollars.
Right.
You
Right.
want to make sure that they're good, they have the insurance and everything, and they're a reputable company.
Yeah.
But
That's what it
they'll
comes down
have
to. They're going to have insurance behind it. Is there some kind of certification or anything like that that's behind it as well? Or
I don't know that there's a certification, but I know that if they are reputable, they'll have like a website, and then they'll have people that they're going to be able to walk you through the whole thing. And I believe they usually have like an insurance, kind of like a title company does,
yeah.
the same type of things. So you just want to make sure that that person is going to be reputable and be around while you're doing that 1031 exchange.
Yeah.
Um, and then just make sure, and they'll help guide you through anything that you need to do, but then making sure the title is the same.
Yeah.
Whenever I would sell the property or even buy, I always would put on my contract that this is a 1031 exchange, and just to let the seller or the buyer know, and just say, you know, forgot exactly how he worded it, but basically just to convey that, hey, there's no cost to you for you to do this, but we just want to make sure that you understand that it is a 1031 exchange. And so if there's any delays or something like that, to be understanding,
Yeah.
right? So
Yeah.
that's
Always
kind of
best to
why
be
we do
fully
that.
transparent with what you're doing, and just like there's no reason to hide anything like that. Just put it out there and let everybody
Yeah,
know. And just because there might be a hiccup that comes along, or you might need an extra week to do something, or whatever it may be. So
yeah,
yeah, disclosing all that stuff is, I think, is always just best, no matter what it is.
yeah. Correct. So basically I mean, but it usually doesn't change much, because it doesn't take any extra time. All I have to do is, instead of me going to the bank and wiring the money, I just contact the exchange accommodator and say, can you wire the money?
Yeah.
So it shouldn't take any extra time. I just put it out there just to make sure that they understand. And in case something happens, if there's a delay or something, I can say, well, it's due to the 1031 exchange. We told you about it before,
Yeah.
you know?
Yeah. So no. So what are getting into somebody's looking to do a 1031 exchange, or just to kind of do some, hey, be careful of this, or be on the lookout for this, or what are some maybe mistakes that you've heard about, maybe have seen, or even maybe made yourself? They're like, hey, if you're if you're getting ready to do this, like be careful of this, or look out for this.
Well, the main things are making sure that the vesting is the same.
Yeah.
So however you're selling and buying has to be the same. Making sure you contact that exchange accommodator before you close and before you receive the money. Once you receive the money, you're done. You're not going to do a 1031 exchange anymore. And then just making sure you're following the timelines. 45 days doesn't seem like a lot, but right now, especially in a hard market, you really need to have properties close to being available. I mean, 45 days can go like that
Yeah.
if you're trying to find, 3, 4 properties. If you're trying to find one, it's probably going to be a little bit easier. If you're trying to find 3 or 4 properties, make sure you have that good relationship with, a wholesaler like yourself to say, hey, I need some properties.
Yeah.
Send them over.
Yeah, there we go. So, and just to clarify that a little bit, so you have 45 days to identify the properties and then 180 days to close on them, correct?
Correct. Yeah.
Okay.
So you can close them. I mean, you can sell your property today and then tomorrow close on all of your properties. I mean,
Okay.
I don't know how you can find those properties that quick, but technically you can do that. But they, give you that time to do the 30-day inspection, getting your financing lined up and everything. So they give you time. It's just 45 days seems like a lot, but when you're getting more and more properties, I remember running up to the last day going, okay, we're going to throw this property on just to make sure, we have enough properties.
Yeah. And that's a really good idea. Just like you said, you were identifying, you're looking for 3, but you were identifying like 10, just to be kind of in that situation and stuff. So Grant, one of my, I'm wondering like how, so like, okay, I have a property, I'm going to do a 1031 exchange. I know that. Can I start looking for properties now and identifying properties or getting even properties under contract before I actually sell my property that I'm going to do the 1031 exchange off of?
From what I understand, you cannot have it under contract
Okay.
until after you've sold. Now you can start looking.
Yeah.
So, if I saw a great property come by my desk from you, I might say, hey, Brian, especially if I have a good relationship with you. Hey, Brian, I'd like to buy this, but this other one's closing next week. Can you hold off? Right.
Gotcha.
Like you might be able to do that. I'd start looking, start seeing what the market has to offer. And then just make sure with the accommodator, if you can actually get it under contract before, if you need to.
Yeah.
But the bad thing about doing that is if the sale delays, then you're going to have to delay the purchase too. And the other seller may get nabbed.
Yep.
So that's one of the cautionary things that I would say, especially about trying to actually locate one. But I'd start the process looking at properties, going through properties and following the market, especially once it's ramping up that you've already got that other house under contract for sale. It's past the inspection period. It's almost a done deal. Really start looking for properties and trying to locate exactly what you want to buy. And then once that property closes, start running, start making every offer you can.
Yeah. So that's funny. What costs are involved? So if you're doing a 1031 exchange, like what cost is involved for that person that's doing that?
So the asset preservation that I've used, how they do it is I've only paid $1,000 for the actual 1031 exchange.
Okay.
And then it's, I believe it's $1,000 for the sale of the property and then to buy one property. So if you're doing only 1 for 1, it's only $1,000. But then once we started adding more, each other property was $450.
Gotcha.
So it's really not that expensive to do it. I mean, if you really think about it, all of the accommodator is really doing is accepting your money, making sure that all the documents are signed and in order, and then sending out the money. They're doing the wires. They're going to ask you, okay, do you want me to send out the deposit, or do you want to send out the deposit?
Right.
So depending on where your funds are going, I usually would just say, can you just send out the deposit to them? And then if the deposit gets returned, it goes back to them.
Yeah.
And then they take that money.
Yeah. So I know the kind of the hot topic has been with Biden or just the administration now. I won't put it all on Biden, just the administration now. We'll say that that's kind of what's going on with 1031 exchanges on kind of I know they've even, especially with like kind of the multifamily stuff of going from the single families to multifamily. That's been the big one. I think that they've kind of talking about it possibly not doing anymore. Or like, what's the kind of the latest updates if you can give us that kind of like where 1031 exchanges stand and kind of just maybe I know you and I've had this conversation too of like kind of your opinion on like, hey, what's like, why would they take this away? Like, I don't see it coming. So.
Well, first I've been hearing it's going to be on a $2 million or more. So if you're going to make $2 million or more, that's where you can't do a 1031 exchange. Well, None of my properties were making 2 million, and they were. I probably wouldn't have just sold them. But
That's why you're in Indy instead of California, right? So
yeah, but in all, I don't think it's going to happen. First off, Biden himself has used 1031 exchanges in the past to change a property. So, and I think legislators use it themselves. A lot of legislation people invest in real estate. So I just don't foresee it happening because it benefits them.
yeah.
And if it benefits them and not taking money out of their pocket, then they're not going to do away with it fully. Now, maybe they will keep it at a $2 million cap, which most people will probably be underneath that $2 million. And if they do that, most people, it's not going to be affected.
Right.
But the bad thing about it is, if you think about it, right, there's a lot of people who have, typically people start with single family houses, and typically people start investing in lower end single family houses.
Yeah.
So then they buy 5, 10, 15, 20 of those. And then they want to say, okay, this is way too much work to have all of these properties in different locations. I want to buy an apartment complex. Well, 1031 exchange is the perfect scenario for that. You take all of those profits and transfer them over to another property, gives other investors, newer investors, the opportunity to buy now all of your 20 properties. And now you've moved on to an apartment complex who that person probably moved from that small apartment complex to a bigger apartment complex, right?
Mm-hmm.
So you're getting that funds moving around that I think could stop if they completely get rid of 1031 exchanges. And I think that that's a horrible idea, because that continues with money moving around, and that keeps brokers paid. It keeps contractors paid because they're going in and fixing properties. It keeps new investors coming in and buying properties and moving up. I just don't see that happening.
Yeah.
But weirder things have happened. So.
Right. Well, hopefully we don't have to edit this. Hey, we'll just omit this episode before next week. And hopefully that won't happen or anything. So,
yeah.
We'll see. No, Grant, I really appreciate all the insights and what you've given here today and stuff like that. Is there anything else when it comes to the 1031 exchanges that we didn't mention today or didn't go over? I know there's quite a few things, but any big thing that hey, let's talk about this before we get out and wrap this episode up.
I would just say people, especially from states that have high appreciation, right? That if they've owned the house 5-10 years, they've gotten a lot of appreciation. They have an opportunity to make that equity work for them by doing a 1031 exchange. Yeah. If they believe their area is at the max or almost at the max, sell it. Buy other properties in another performing. As much as I don't want more competition in Indianapolis, competition is good. I don't fear it. I think that everybody should be investing somewhere. Find a good location to put that money and maybe spread your risk like we did. And I think 1031 exchange is a very awesome thing to be able to move money from one spot to another and invest in real estate, which I love. So
yeah. So awesome. I love it. So Grant, if somebody has a couple questions about 1031 exchanges or just kind of anything to follow up with you on, what's a good way for them to get out or get in contact with you?
Yeah. So my phone number it's a 916 number from California. So it's 916-616-1264. And my email address is grant@thegoodlifeproperties.com. They can reach out to me and I'd be happy to help anybody that I can. And hopefully we're all in this together to make, we all want to make sure everybody's making money. So I'm more than willing to help people out when I can.
Yeah. So I love it, man. And I'll just say, just to give you some kudos, man, you are definitely just a go-giver. So I know that, just from the, 3+ years that we've known each other, I've always seen you helping out and just encouraging people and giving, whether it's knowledge or time or just resources. I definitely view you as somebody that's always willing to do that. So I know I appreciate that. I know the Indianapolis real estate community also appreciates that and stuff too. So thank you very much, my man.
Thank you.
So,
Thanks
with that, I'm going to ask a little bit more for you to give on this
Yeah.
next episode as we
No problem.
we'll wrap this one up here, and then we're going to do another episode with the Grants on the Burr strategy. So we'll see you guys next time on the Indy Investor Pod. Take care.